It's been known to all of us that Indian aircrafts cannot fly over the Pakistan's airspace. Imagine a flight taking off from Delhi which has to go to Dubai. This flight usually used to fly over Pakistan. No, because of the tension in the border and Pakistan closing the airspace, this aircraft which starts from Delhi has to come down to Ahmedabad, Gujarat, and then fly over the sea into Dubai. Obviously, we all know that whenever this direction change happens, there is increase in the flight time. Aircraft has to be in the air for slightly longer time, roughly about 40-45 minutes increase in the duration of the flight. When this duration increases and distance increases, fuel cost increases and the time has increased. So this air cabin crew is there, pilot, air hostess, everyone, they have to stay in the aircraft for longer. So they will do lesser number of trips in the day. Their stay cost will increase, staff cost will increase, fuel cost will increase, overhead cost will increase. Totally, as an Indian Airlines, may it be Air India, may it be Indigo, my cost will increase. Guys, agree? And I would have to recover that. And if in case I would have to recover that and I charge more to my customers, they will not buy tickets from an Indian Airlines. They'll buy tickets from Emirates and foreign airline industry for whom Pakistan airspace is still open. They can still fly straight. We would have to do this and all. So when my cost has increased, to recover my profit, if in case I increase the sale price, number of units I sell will decrease. So I would have to sell at the same price like everybody else selling. So if I sell it at the same price, then that's when my number of tickets that I'm selling won't dip. But we all know that when our cost has increased and if we are in a market competitive scenario because of which we cannot increase our selling price, we will incur loss. My question to all of you to think is, when my cost increases but my selling price doesn't increase and I expect loss in the future, take Indigo Airlines as an example. Let's say they're going to make 200 crores additional expenditure on fuel, 200 crores extra expenditure on staff cost, everything together, about 200 crores. Just as an example, these are not real numbers. These are just imagined numbers. If in case you're incurring 200 crores extra on your operational costs in the next 1 year because the Pakistan airspace is closed, how should Indigo account for this? Answer this with the help of your accounting standard knowledge is the question. Answering, it's pretty simple. We need to check accounting standard 28. Aircraft being treated as a cash generating unit, it will be recorded at its cost of acquisition minus accumulated depreciation on the same. That would become my WDV value in the asset side. If there are any indicators of impairment, there is some adverse scenario affecting the market because of economic conditions, legal conditions, technological conditions, or market conditions where your competitor has an advantage of lower cost, but you don't, or there is any geopolitical situation happening. Because of this, if your cost shoots up and your profit dips, there is an indicator for impairment. What is it that you should do in this case? You need to identify recoverable amount from the CGU. Recoverable amount means today, if I continue to run this airline, how much money will I recover? The recoverable amount is identified as higher among two things. One, net selling price. Two, value in use. Value in use is present value of the future cash flows that I'll get by running my business. If I continue my airline business, ticket sales revenue I'll get. That ticket sales revenue minus expenses that I'll incur will get profits. That profits for all the remaining upcoming years discounted to present day will be my value in use. My sales revenue I can estimate. Cost has increased cost will give me lesser profit. Lesser profits for next 3-4 years discounted to current year, that would become my value in use. And this has to be compared with net selling price. If in case today in the fair market, if I sell my assets, what value will I receive? Among these two, whichever is higher will be considered to be the recoverable amount. And obviously, we all know that value in use will dip because our profits has dipped. That when we say value in use, no, we need to take present value of future expected cash flows. What is present value of future expected cash flows? When we did questions, it was all simple. They had given the numbers. But when you do it in this case of scenario, you need to take sales revenue minus expenses expected, projected to arrive at expected profits. That has to be discounted. When we take these two, whichever is high will become recoverable amount, and that would be compared with our carrying amount. If in case our carrying amount is more than the money that we can recover, then it would be impairment loss, which has to be adjusted against the cost of the asset. If in case there is goodwill when we acquired it, then goodwill would take the blow before that specific asset, and such an impairment loss should be transferred to profit and loss account. However, if in case there is revaluation reserve in our balance sheet, before transferring it to P&L, we would be adjusting against such revaluation reserve. I hope you understood. That's it for this. See you all in the next one.